Hello, my name is Raquel Young, and I'm a volunteer with CPA Canada Financial Literacy. I'm pleased to be here with you this afternoon to discuss the presentation, The Money Side of Business. This presentation was designed for existing or prospective entrepreneurs who are looking for some tools or metrics to measure their financial performance of their business. At this point, you can break the ice with your introduction by asking the audience what brings them out for your presentation. Are they currently small business owners, or are they looking to start a business in the near future? For today's agenda, we're going to be going through commonly asked questions by business owners. We're going to start off by introducing what is financial management. Then we're going to go through some tools that can help you operate your business. Then we're going to help you determine how to rank your products by profitability and to identify what your most profitable products are. Then we'll look at who your most profitable customers are, why you need a budget, how to create and use a budget. Then we'll go through a set of reports you can use to help you with your budgeting. Then I'll give you some tips and tools to teach you how to read where your business is heading. So what is financial management? Financial management is a set of activities intended to track performance, analyze results, and to take action to remedy things that were unexpected from what you had planned. The point of financial management is to focus on profitability and other business goals. For the remainder of the presentation, we'll be teaching you tools of financial management that can help you to guide your business. We're going to go through financial statements, budgets, forecasts, and industry benchmarks. Financial management can be thought about in several steps. This diagram shows you a logical sequence of how you can be thinking about financial management. We can start off by doing a customer and product analysis, followed by timely reporting. Then we go through budgeting, a cash analysis, and you end off the cycle with performing a project and trend analysis. For the rest of the slides, we're going to be going through the details of how to perform each step. The first step in financial management is to look at the products that you're selling and to do an analysis on the profitability of these products that your business is selling. So how do you do this? You can start off by listing all the products that your business is currently selling, then identify the gross sales for each product. Gross sales can be calculated by the sales price of the product multiplied by the quantity of the products that you're selling. Next, you should identify the cost of goods sold for each product, which is calculated by the unit cost of each product multiplied by the quantity of units sold. Then, by using your gross sales minus your cost of goods sold, you can come up with the gross profit for each product. Using the gross profit, you then sort these products by their profitability, and then you can see, based on the numbers, which product is contributing the most to your business. At this point, you can pause your presentation and ask audience members if they understood your explanation. Maybe not everybody comes from a business background, but in this case, you can really reassess if your audience is following you. Now, the shortcoming with simply looking at gross profit is that it's a very volume-driven number. Perhaps a better measure of profitability is looking at gross margin, and gross margin is the profit contributed by each unit of product you're selling. So let's take a look at how to actually calculate this. Gross margin uses gross profit, which we calculated, which was gross sales minus cost of goods sold, and you divide that over sales. This will give you a percentage. Now, the only thing to remember is that for this ratio, the higher the ratio, the better. It just means that the product is more profitable. Once you know how profitable each product is, what can you do? Well, you could start off by comparing these products to the market. It's important to measure your profitability of each product against industry benchmarks to see if you're in line with your closest competitor. Next, this will give you opportunities to adjust your pricing to enhance profitability if you're way off from benchmarks. You should be focusing your marketing and delivery methods on the most profitable products and consider dropping unprofitable products from your list. Products should be profitable, be made profitable, or serve as a loss leader. You could be very profitable in a product, but if it's priced too high, where your profitability is so high, you could be reducing your sales. People won't be attracted to actually buying the product. So at this point, when you're measuring pricing and profitability, it's important to adjust it so that you're still attractive to your customer in the end. The next step in the financial management that we discussed a few slides ago is to perform a customer analysis. So we've done an analysis on our products. Next, we want to know to whom we're selling our products to and whether or not these are profitable customers. You could start off by listing all the customers or customer types that you have in your database. Customer types are maybe your customers are segmented by individuals versus businesses. Then you should identify your typical shopping cart per customer. So for example, businesses might be high volume sales, whereas individuals might be more picky. They look for sales or smaller basket purchasers. Similar to the product analysis, you should be identifying the gross profits contributed by each customer. To remind you again, gross profit is calculated by taking your sales minus your cost of goods sold. Next step is to identify the gross margin for each customer. Again, gross margin is calculated by taking your gross profit over sales, and this gives you a non-volume driven number to work with. Once you know how profitable each customer is, you could sort these customers by gross profit and gross margin, and then focus your marketing and delivery methods on just the most profitable customers. Similar to what we did in the product analysis, you can then decide whether to drop unprofitable customers. For example, you're running a consulting business and you're charging a fixed fee per customer. But based on this analysis, you find that for one of the customers, you're spending 5 hours or more on a file that actually you're not charging for. So in this case, if the person is using more time than they're worth, you may consider dropping them. Customers should be profitable, be made profitable, or serve as a loss leader. At this point, you may consider pausing your presentation and asking audience members to pair up and give 60 seconds to each person to review all the things that you've gone through up to now. Remember, not everyone in your audience comes from a finance background or accounting background that they can remember all the ratios and calculations that we've discussed. So this is a great time during the presentation to pause and make sure everyone's up to speed with what you've covered thus far. The second round is 30 seconds long, and they can look at their notes to see what they missed. The remainder of the presentation will focus on the key financial management reports. We'll introduce the 3 primary financial statements you should be familiar with. They are the P&L, also known as profit and loss statement or income statement, the balance sheet, and the cash flow statement. The income statement gives the financial results during a specific period of time for the business. So businesses operate on a 12-month cycle, either by the calendar year or a fiscal year, any 12-month period in the year. A balance sheet gives the financial position of the business at a point in time, and they list the assets, liabilities, and owner's equity of the business. A cash flow statement shows the changes in the cash account and shows where the cash is used. In the next couple slides, we'll also discuss a few profitability ratios that you should be familiar with. The objective of using ratios is to give a comparative value for businesses that are of different sizes. And so we'll go through a few of those. So one of them we've already discussed is the gross margin ratio. The last area that we'll be talking about is budget with forecasts. We'll discuss the importance of why it's important to review it on a monthly basis and present them using graphic charts. Budget and forecasts are important because they allow business owners to stay out of trouble and adjust his or her business to take advantage of opportunities. So let's take a look at the first profitability ratio that we've actually discussed earlier on in the presentation, gross margin. Gross margin is calculated by taking the gross profit, which is gross sales minus the cost of goods sold, and dividing that by revenue. Now remember, gross margin is a per unit measure of the profitability of a product, and so that means that this could be a very comparable ratio to measure across businesses of different sizes. Let's take a look at an example using numbers. In this calculation, we have gross sales of $20,000 minus your cost of goods sold of $9,000, giving a gross profit of $11,000. By dividing $11,000 over $20,000, you get a gross margin of 55%. This means that for every $1 of sales that you generate, 55 cents is considered gross margin. With gross margin, the higher the ratio, the better. As I mentioned, because gross margin is a number that is comparable to companies of different sizes, it's important that you're using these ratios and comparing using benchmarks. That way you can tell that, for example, if your gross margin or If the industry benchmark gross margin is 55% and yours is only 20%, you may have a pricing problem, and that will highlight the need to adjust your pricing. The maximum gross margin is 100%, which indicates that there's absolutely no cost to the products that you're selling, and a negative gross margin indicates that the sales are not even keeping up with the cost of your goods. If you find that your gross margin is negative, that's a red flag for you to drop that product. The next ratio that I want to introduce you to is the operating margin. This builds on the gross margin that we discussed in the last slide by now taking into consideration operating expenses. Operating expenses are things like paying for salary, for rent, or for general selling and admin expenses. Let's go through the numeric example that we started off in the last slide. So remember, we have gross sales of $20,000 minus cost of goods sold of $9,000 minus operating expenses of $5,000, giving us operating profit of $6,000. To make this number comparable to industry benchmarks or to other comparable businesses of different sizes, you want to take this $6,000 of operating profit and divide that over $20,000, which is your gross revenue. This gives 30%, or also known as operating margin. Similar to gross margin, the higher the ratio, the better. It's important to compare your ratios against industry benchmarks to ensure that the number that you're calculating is in line with how everyone else is doing. If every other business like yours has a 30% margin and you only have a 15% operating margin, you may have a pricing problem or operating inefficiencies and may not have enough operating margin to cover your taxes and interest payments. We're going to talk about taxes and interest payments in the next slide, so don't worry about that for now. The maximum operating margin is 100%, and that would indicate that the cost of your goods is free and that you have zero operating expense. The opposite of that is if you have a negative operating margin, and that would indicate that profits are not enough to pay for the cost of goods or operating your business. Building on from the operating margin, I want to introduce you to the net margin. So the net margin now takes into account not only your cost of goods sold as expense, operating expense, but also taxes and interest. So let's continue with this numeric example we have. We have your gross sales of $20,000, you subtract your cost of goods sold of $9,000, then your operating expense of $5,000, and then you minus taxes and interest owing of $2,000. This gives your net profit of $4,000. Net profit is the money you can take home after all costs are considered. To make this number comparable to industry benchmarks or to other comparable businesses, let's change this number into a ratio. To do this, let's take net profit of $4,000 and divide it over your gross sales of $20,000. In this example, it gives 20%. Similar to the other ratios we've discussed, the higher the ratio, the better. And it's important to measure your ratios against industry benchmarks. For example, if the industry is averaging 20% net margin, yet yours is only netting you 1%, this could indicate a pricing problem or operating inefficiencies, and that you're not making enough profit to fund research or business growth. The last two ratios that are commonly used in the industry is called ROA and ROE. ROA stands for return on assets and ROE is return on equity. Both of these ratios are return on investments or ROI indicators. So the return on assets is measured by taking your net profit, which is what we calculated in the last slide, which is your gross sales minus your cost of goods sold minus operating expenses and taxes and interest. So basically, after considering all costs, that's your net profit, and you divide that over total assets. This gives a measure of efficiency of how well you're converting your business resources into profit. Remember, management's most important job is to make wise choices in the allocation of its resources. ROE, or return on equity, is measured by taking the net profit divided by owner's equity. Owner's equity is the amount of money that owners or investors have pooled into the company, and this gives a measure of how efficient they're able to generate profits on the money invested into the company. ROA and ROE are typically used to compare one business to another. They can also be compared to the returns on bonds and bank savings. So, for example, if a bond's yield is 3% and your ROE or return on equity is 15%, this gives an indication that your business is generating a lot more return for the money invested. And hopefully, if you're actually looking for more investors, this will attract more investors to invest in your business. Now, similar to the other three ratios that we discussed, for ROA and ROE, the higher the ratio, the better. Why do I need a budget? Budgeting allows you to clarify where the business is headed, to understand what is likely to happen in the future, recognize when things are amiss, maximize profits, and to handle adversity. At this point, you can take a pause in your presentation and hand out the document called Vacation Budget Worksheet. This exercise will put into perspective budgeting, but for a smaller personal reason that most people should be able to relate to. Some things they'll have to consider when filling out this handout is the cost of their trip, the type of their trip, the types of expenses they expect to incur, how much cash they currently have, and what the gap is for what they need to have, and think about ways of saving the money to finance their trip. The purpose of this slide is to explain why a budget is an important management tool and how to use it. This is a profit and loss budget variance report that shows the difference between your actual results versus the budgeted amount. Now, remember, the P&L statement is one of the three key financial statements that I discussed earlier in the presentation. And in a P&L report, you'll see the sales, cost of goods sold, operating expenses, and taxes, and then your final net profit. So let's just run through the numbers really quickly. So in the sales category, you had a variance, or your actual sales was actually $5,000 higher than what you had budgeted. Then when you look at your cost of goods sold, it was also slightly higher by $2,500. But this makes sense because the higher the sales, the more cost your goods would cost you. Your operating expenses were the same. Maybe your operating expenses were fixed, so there's a zero variance. And then you had to pay slightly more taxes because your sales were higher, and so you're off by $350. This gives you a net profit variance of $2,150. The key to looking at this report is to really examine each of the variances and make sure there's a reasonable explanation to explain why your actual results differ so much from budget. After performing a variance analysis for a month, you may consider to change your forecast. Forecasts could change as a result of many circumstances. Maybe market conditions really changed from the moment that you did your budget. Maybe you had a huge your competitive environment has changed dramatically. You can change your forecast, but be sure not to change your budget because the budget contains a lot of good educational information that you want to retain for future purposes. The second key financial statement that we discussed is the balance sheet. This shows the budget variance report for a balance sheet. Now, a balance sheet lists the assets, the liabilities, and owner's equity of the company. In order for a budget variance report to be meaningful, it's important to take the time to identify and investigate the variances where your actual results did not align with your budgeted numbers. So in this example, we could see that there was an unexpected additional cash amount of $2,150. We could also see the same amount reflected in owner's equity. Let's take a look at the P&L budget variance report in the previous slide. You will see that the net profit also contributed to the same amount of $2,150 that was unexpected from the budget. It's important to draw the connection that the net profit amount of $2,150 is the same amount that's reflected in owner's equity in the balance sheet. Drawing back to the basic fundamentals of accounting, you might be familiar with the equation assets plus liabilities equals owner's equity. So you can see here that the $2,150 in owner's equity needs to be balanced off on the asset side, and so it's reflected in cash of $2,150. At this point, it might make sense to pause the presentation and ask your audience if they have any questions. You don't know if everybody has the same financial background or education, and we're getting really into the nitty-gritty of details. So make sure everybody knows what's going on and that they're able to follow along with your presentation. Similar to the budget variance report for a P&L, Forecasts can change when variances are significant, but not the budget. If you change the budget during the year, you lose valuable education and information necessary to develop next year's budget. Let's take a look at how to develop a budget. So, developing a budget, you could start off if you're an existing company or business and have previous historical information. You can use your previous year's experience or records as a basis. Then you could identify industry benchmarks using databases and community knowledge and adjust those benchmarks for local competition. You can also seek out your local CPA for expert in developing a formal budget. Remember, some budget is better than no budget. Look for and understand variances and trends. At this point, you can revert back to the exercise vacation budget worksheet and discuss with the audience about other industry benchmarks that they could use for vacation. So for example, they can use sites like Expedia, TripAdvisor, or Google Flights to find what the average price for the items that they've listed are. One of the key takeaways of performing a budget analysis is to ensure that you're analyzing these variance reports as soon as possible. This way you can stay timely and be reactive when it counts. You should investigate and understand all your variances and look for unexpected trends. You can use graphic charts for trend analysis for better visual presentation. And remember, don't change the budget during the year, otherwise you will lose valuable education for next year's budget. Look for and understand variances and trends. Management by budget analysis. By performing a good budget variance analysis, you may find that you can easily indicate sales and marketing successes or failures, changes in the competition, previous lack of understanding in the market, weather, economic, and market changes, and control failures including employee issues that you couldn't previously identify. At this point, you can pause the presentation and ask for feedback from participants based on their own experience with these issues and mention an example of each one. The third type of financial statement that is critical to review is looking at the cash analysis or cash flow statement. Failure to manage cash is a common cause of business failure. The cash flow statement is a primary tool to monitor how cash is used. You can use the cash flow statement to identify any mismatches between billing and payments and learn to stretch payments to vendors. For example, you pay your bills on time, but your customers do not. Mismatched timing of cash receipts and cash outflows can lead to dire consequences. Did you know that rapid sales growth is not always a great thing if you cannot manage your cash properly? We're going to get into details of how that becomes dangerous in the next few slides. Finally, it's also important to monitor your accounts receivable because high accounts receivables can use up cash. What this means is that you've made the sale, customers owe you, but they haven't paid for their products. So in lieu of that, you're actually using your own cash to be paying for other things, operating costs in your business. So both success and failures can use up cash. At this point, you can ask your audience for any feedback that they've had based on their personal experience of any struggles or issues regarding cash that they've encountered during their experiences running the business. Let's take a closer look at an example of reviewing the cash trend analysis and how to spot patterns that may be important to your business management. This slide shows 6 months of budgeted to actual of your cash account. So in your budget, it looks like you anticipated 6 months of increasing growth of your business and therefore increasing cash. But in actuality, if you look at the numbers for January to June, almost every month was below your budgeted amount, except for January, which was the same as your budget. So in this example, it's important for you to understand why you're not receiving as much cash as you anticipated. Is it due to lower sales than expected? Is it due to customers purchasing more products on credit? Are you using more cash to purchase your products? So is the cost of goods sold increasing that you didn't expect? It's important to understand the variance between what your actual results showed versus what you had budgeted. Not only do the numbers give an example of what's going on, but if you display it with a graphic or a chart in this like the slide is showing, it can give you a better sense of how far you are from your budget. Some general points to consider. How can I use forecasts to prevent disaster? How can financial ratios be like warning lights? How can great success turn into a failure? So let's talk about forecasting. Forecasting is critical for a successful future. You can think about forecasting in two time frames. The short-term, 1-year time frame is called budgeting, whereas forecasting for a longer period of time of 2 years or more, up to 10, is called projections. You can forecast using financial statements and ratios as tools. When performing forecasting, you need to keep in mind that your actual results will always be different than the projections. The key to the exercise is really to understand why the results are different, but not to match exactly your landing of your actual to your projections. Forecasting is required to maximize profits and handle unexpected adversity. You can think about the importance of forecasting when you're planning your trip and you want to know what the weather forecast is for it could be a weekend trip or a week-long trip. You want to look ahead to these different time horizons in order to plan your trip appropriately. The same can be said for a business. Projections show where the business is heading, and it can use trend and variance analysis to explain if your business is going off course than expected. Remember, perfect forecasting is impossible. The key points to take away from this exercise is to investigate and understand the trends and to understand any differences between your actual results versus your forecast differences. Without a budget and forecast, you will end up somewhere surprising. This chart shows the trend analysis of gross sales. If we take a look at the chart on the right, we can see that the budgeted gross sales for 7 months seem pretty steady, whereas the actual sales was actually increasing by a lot more than expected. And you can see that by that steep line there. It's important to consider the difference between your actual results and your budget and to think about the positive and negative effects of each. In this case, the positive effects of having gross sales increase so high is that you would expect increased income, perhaps enhanced reputation in the market. Maybe your company is doing really well, obviously. However, it's also important to look at unexpected side effects of gross sales being much higher than your actual. In this case, this might eat into cash. It might cause more work hours for your company or people to service those orders, and overall increased stress to your company that was not forecasted or not expected. The last trend analysis we'll take a look at is the accounts receivable. You can see in your budgeted column that you had expected your accounts receivable to stay steady for the next couple of months, but in fact, the actual results showed that your accounts receivable was growing. It's important to consider what this means to your business. The potential positive effects of increasing accounts receivable may indicate increased sales, but the potential negative effects may mean that you're eating into your cash resources, which may reduce the business's ability to pay suppliers and employees. In summary, in this presentation, you learned of a few handy tools to keep your business in check, including how to evaluate the profitability of your customers and products, tracking your financial results using the 3 key financial statements, and introducing some key metrics that industry professionals use to measure operating efficiency. If you would like more information on the topics that we discussed today, I will leave you with a glossary of terms and an implementation checklist that summarizes all the key subjects that we talked about today. At this point, you can end your presentation and ask if the audience members have any questions that you can help answer or clarify. If you don't have all the answers to your questions, you can direct them to additional resources that CPA Canada has provided. Thank you very much for joining me in today's Money Side of Business presentation. I hope you enjoyed it as much as I did, and I look forward to seeing you at the next CPA Canada Financial Literacy presentation.